Tim Cook, CEO of Apple, sent a letter to shareholders, and it went something like this. Dear Apple shareholders, remember back in November when we forecast that our first quarter revenue was going to be somewhere in the neighborhood of $89 to $93 billion? How would you feel about $84 billion instead? And shares of Apple are down 9% today.
Yeah, the attempt to sort of spice that bad news up with, by the way, we're going to have an all-time record for earnings per share, didn't seem to work as well as, well, I don't think there's any surprise here when you lower the revenue guidance as much as they did, especially for Apple, which is well known for providing very cautious guidance, largely accused of sandbagging on guidance for the last decade at least. And so when they say 89 to 93, the usual response is, all right, let's start with 93 and then add a little bit more on it. This is talking about the Wall Street analyst community. Normally, for many companies, you take the midpoint of the guidance as if, oh, we've really evaluated this and somehow we've come up with the exact midpoint of the guidance that has been handed to us.
$91 billion.
But with Apple, you're going to be above that because history has shown you that that's what is likely to come in closer to the reality. And this time, no such luck.
So Apple's going to report their first quarter earnings somewhere in the neighborhood of, I believe, February 7th. So we've got a little over a month to go. And Cook gave an interview with CNBC where he talked about traffic being down in their stores. He talked about China. A lot of it was about China. He said he hadn't seen the December numbers yet. But clearly the indication was that they were bad enough that they're lowering guidance very early in January. And in that interview, he seemed to spell out two basic challenges that Apple is dealing with, one of their own making, one not of their own making. The not of their own making is the macroeconomic environment, the slowing of the economy in China, the trade war having an effect, that sort of thing. Of their own making is the fact that they're selling a $1,000 phone and trying to get a lot of people to buy it at the same point in time when, and he made reference to this in the CNBC interview, he talked about the battery replacement program that they did last fall, how they dramatically lowered the price of the batteries. I think it was down to $29. And so you had a lot of people taking advantage of that. And because of that, they said, well, I don't need to upgrade my phone. Why would I go out and upgrade from an iPhone 6 to a 7 or a 7 to an 8 when the battery was the problem and now it's fixed?
Yeah, I think that in a lazy world, you would refer to this as a perfect storm. I've always considered that to be among the laziest evaluations of what's going on, is to find three factors and combine them and pretend that somehow that's a unique circumstance. But you've got China generally slowing down. You've got China-U.S. specifically being an issue, and Apple in many ways being a sort of a poster boy for the U.S. And then you've got Apple's specific choices, as you mentioned, being largely around the pricing of their product. And they make better and better products, but there appears to be a limit to which large numbers, or at least sufficiently large numbers of people will go in terms of buying a new phone when the one that they've already got is already awfully good. And the Apple's history of being able to encourage people to upgrade their phones again and again and again has taken at the very least an interruption. And they are talking, Tim Cook is talking about the various ways that they can kind of mask the real cost of the phone by getting people to pay in installments or, transferring of course, it was masked for a long time in terms of what you would pay because the service carrier was picking up part of the real cost and you were paying for that in your contract with AT&T or whoever. And that's largely been interrupted, and people are seeing the full cost of the phone and are hesitating.
So this is a stock that, as I mentioned, down about 9% today, down nearly 40% since last fall. They got all that cash on the balance sheet. When you look at Apple priced as it is today, do you look at it as a buying opportunity, or do you think this thing has further to fall? Because the CEO himself said yesterday, I haven't seen the December numbers. It's not out of the realm of possibility that the December numbers are actually worse than he and his executive team are imagining.
Well, I guess to be wishy-washy, I would say both. I mean, I think it's got further to fall in the short term. And that said, given the cash, the net cash, which I think the letter refers to as $130 million right now, that's about $30 a share. 130
million or billion?
Billion.
Billion. Because that's a big difference.
Well, some would say.
Well, 3 more zeros anyway.
A day like today, who can tell? But so 30 billion, 130 billion, that's about $30 a share on the share price. And because they're about 4.7 billion, so I'm rounding up. It's not quite $30 per share. But off of, you take that out of the, call it, what is it, 144 right now that Apple's going for? Something like that. So you're spending about 114 net of the cash. It's got about $11 a share earnings, so about 10 times the earnings power of the company. And what are they going to do with all that cash? They're going to keep buying back their shares, which they've been doing pretty aggressively over the last 6 years. So over the last 6 years, earnings per share have grown 11% per year for Apple. And that's off of a peak. 6 years ago was an interim peak. And the actual net income has grown about 6%. So they've not quite doubled their earnings per share growth by buying back what is closing in on 2 billion shares. They've bought back about 25-30% of the company over the last 6 years. And they can continue to do that, buy back maybe 5% a year of the company with just cash on hand and the cash flow that they're getting, and continue to pay the dividend, which is yielding about 2%. So you may see an interruption in their growth. Of course, the letter refers to all the other areas other than the iPhone as doing pretty well. I think they referred to, I want to say, either 19 or 29% growth in the other areas of the company. And that's not bad. So the diversification outside of the phone is a net underneath things, but iPhone's still certainly the biggest part.
Absolutely. And the services business has been steadily growing, and it's now, I would say, more than meaningful revenue. But as you said, this is all about the iPhone. And as long as the iPhone is not flying off the shelves, then we're going to see days like this.
So let me, just get the number right. It is in the letter that revenue outside of our iPhone business grew by almost 19% year over year, which is pretty good. And it is a very large company, the non-iPhone part of Apple, which is, the HomePods and all the Macs and the iPads.
The watch.
Yeah, the watch, the services. Services were $10.8 billion for the quarter. There's a lot of very, very large business going on outside the iPhone, but the iPhone is the biggest chunk, certainly.